think what's happening is that investors are beginning to lose confidence in the projected economic and earnings growth for the remainder of this year and into 2022. Also, the second quarter of 2021 is expected to be the peak quarter in this earnings cycle. So after this reporting period, we will be on the leeward side or the downward side of this earnings mountain, if you will. The yield having dropped from 1.5 down to 1.1, 1.2, I think represents a canary in the coal mine, meaning that bond investors, as well as equity investors who are bailing out of stocks, are worried that this COVID variant will cause many more problems with the unvaccinated than was anticipated. So the worry is that parents are going to not send their kids to school, that we're going to have mask mandates all over again, and that the economy will slow once more, and that will put a damper on all of the enthusiasm that had already been built into stock prices. I think that right now it's profit taking, and then the real question is, how far down does it go? We have gone almost 300 days since the end of the last decline of 5% or more. So back on September 23rd of 2020, when the S&P fell almost 10%, marked the bottom of that deep pullback. And we've been in an up mode ever since. So it's due, in my opinion, for a decline of at least 5%. And if we actually go down to the 200-day moving average, we're looking at something closer to 12 or 13%. So I think a correction is very likely, but I think a new bear market is very unlikely. I think that there will present a time in which it'll be better to buy than bail. That if you have had your eye on stocks that you feel that you missed out on, I would think that in the coming weeks, they could represent very attractive investments all over again. So I would say, don't bail out of stocks, but rather look for better entry points for those investments you feel you might have missed out on. Well, I think that the materials sector, which has fallen quite dramatically over the last several months as investors started to question the value trade, will be representing a good investment opportunity in the near term. And industrials, which we thought were going to do well because of the potential infrastructure spending package, which this group has really lagged behind the market and its peers, I think will start to improve once again, once this correction has run its course. The real question is whether interest rates will start to climb once again. If they do, well, then that would give further reason why financials, industrials, materials could do well. If they remain very low, then I think investors say, forget value, let's go for growth. I think it depends on how long this Delta variant will wreak havoc on our mindset and our economy. If it does end up being longer than a month or two, then I would say yes, that it's the stay-at-home stocks that are likely to do well. So such areas as technology in general, communication services, maybe even some of the consumer discretionary groups, where you order online, et cetera. And it'll be done at the expense of the more value-oriented areas, especially the travel and leisure areas. Also, I think that healthcare might get a shot in the arm, pun intended, and that the defensive consumer staples, food, beverage, tobacco, could hold up well as investors again decide they need to buy more toilet paper.